Hey everyone, welcome back. It is February 18th. My name is Levi Woods. This is Drawbridge Finance. Hope you're having an awesome time. Joining today, we're talking about options, stocks, strategies, anything you want to talk about. I don't usually have a format for these live streams on Tuesdays. I just let you dictate what you want to talk about. So I've been trading options for a very long time. I've been stock trading for almost 30 years now, which is kind of crazy. So I enjoy meeting with everybody and just talking about different ideas. Of course, everything we talk about here is not financial advice in any way, shape, or form. It's just what I'm looking at, what I'm doing in my account, and how I might trade the markets. I see there's a couple people online. I see Kevin's on from Lakeland, Florida. John Blake says, happy Tuesday. Happy Tuesday indeed. This is my favorite time of the week because I just get to hang out with people that are like-minded and we get to discuss different ways to make money. Hans is watching from Liverpool. Awesome to have you here, Hans. I don't know if this is your first time, but welcome. Basically, if you have questions about a particular stock, drop them in the comments. I'm going to pull up my brokerage right now. I'm going to talk about what I'm looking at in the market, kind of what direction I am leaning right now. You can see my sign is green, which means I'm actually having an up day today. Most of the markets are actually down just slightly. Volatility's up just a tiny bit. So we'll take a look at that. And if you've got some questions, jump in with them and I will get them answered as soon as I can. Let's take a look at, oh, that screen is on the wrong screen. Let me pull that back into place for us. Let's get that down there. We're looking at the S&P 500 index, SPX marking at $6,113, pretty flat, down 0.02%. You can see this little tiny candle. We saw not a lot of movement on Friday, of course, going into the long weekend, and we're right at these all-time highs. So SPX, is having a tiny bit of consolidation. My assumption is we're going to break out of here. Part of the reason that I think that is because of the NASDAQ. So the NASDAQ is slightly lagging behind. What we're seeing is the market breadth is coming up. We're seeing some pushing, some upward movement in many of the stocks. And of course, both the NASDAQ and the S&P 500 are made up by big components like Apple, Amazon, Netflix, Google, and some of those stocks are not at their all-time highs right now. So if you look at a stock like Tesla, which is a very large component, we are trading in this range down here. And if we can break out of this, if we can get some market sentiment to move to the upside, we should see this push up both the S&P 500 and the SPX. Apple, again, trading lower than its current highs. So when we look at like the SPX, if we look at that same time frame, we can see that the other components, the other 500 components that aren't the top 5, have kind of caught up and they're pushing us up into these levels. And if we can get some movement, here's Netflix. This is a big factor. It has pushed up a little bit, but if we can get some movement from Meta or Google and some continued upswing, which it should do, Nvidia, you'll see it's not at all-time highs. So looking at all of these stocks and saying, if these push up, this should continue to push everything up. If we look at ARK, this is an ETF that tracks technology stocks, and we're definitely in a bullish momentum. I drew some channels on here quite a while ago. So these blue channels that you see are the upward momentum where we're having higher highs and higher lows over time. We're looking at the daily charts here. So these are the dailies, and we can see we've broken out of that. So this is indications that we could push to the upside. We're also seeing gold pushing higher. So this is a continuation in the commodities. So there's lots of money still flowing into the market, and it's kind of spreading itself out across different areas. IWM, let's take a look. This is the Russell. You can see they're a little bit messy on here. I should really delete this. I should just get this off here. There's no need to be that messy with these charts. We're again, similar kind of upward bullish channel, and we have been in this slight consolidation range. I am long deltas in IWM. I really believe that once we get a little bit of a push, if there's any Fed talk about interest rate cuts at all, we're gonna see this index push up. VIX trading at a very low level. This is not great for premium sellers. So if you're a premium seller, which I prefer to sell premium, but we can't always do it. It's not always working for us, and we have to do this when the volatility is high. So when we have volatility that's low at this 15.5 level, which is below the red line, which is our average around that 17 to 18 level, when we're in these periods of low volatility, I tend to lean towards setups like diagonals, or I do defined risk trades like iron condors and butterflies. Not doing a huge amount of condors right now. I don't want to stay that neutral. I want to have a little bit of long direction. And so I'm doing these butterflies that have no upside risk, especially on underlyings like gold. So when we're looking for that push up, we've been able to make money over the whole course of this year with this up move, and we've got a little bit of cushion with profit spike to the downside. So that's kind of how I've been setting those up. I would love to see what tickers you guys are thinking about. Type them in the chat window on YouTube. Let me know the symbol of the stock that you're looking at and the direction you think it might go. Then we'll pull this information up. I'll take a look at Seeking Alpha. We'll look at Investing Pro, and we'll look at some of the fundamentals of these stocks. And we'll talk through it together and see what we're going to do. I see Terry's joining from from Alberta. He's saying, thanks again for all you do for us. Could I get your opinion on Sofi for a covered call strategy? Absolutely. I am running a covered call on Sofi right now. I have currently the 15 covered call. Sofi is trading about 16 and some change. Let's pull it up and take a look. 1680, something like that today, I think. And let's just jump over. Let's look at Sofi. Tons of premium in this little stock. You know, I know Invest with Henry uses this quite a bit, and I understand why, because the premium can be about like 3% a week, which is crazy. You know, when you've got a covered call strategy that can generate about 150% annualized return, just selling the same strikes over and over again, they can be pretty lucrative. It has come up into this range. I've been trading the 15, so I'm just trading the wheel on it. I start at the 15 short strike, or short call, or sorry, short put rather. If I get assigned, I take assignment of the shares, and then I sell a 15 covered call against it. Pretty simple strategy, pretty straightforward, and with enough premium that I don't have to worry about it. Also, a fairly small stock, which was trading at $8 before, so could easily come down. We have to mitigate our risk on these. One of the ways that I would like to trade something like this is I want to trade when it's in these lower parts of the range. So I'm looking for opportunity to buy when it's hitting these lower bands. I'm typically not selling off shares like this, but when I am entering positions, I'm often doing it by purchasing more than 100 shares. So if I was assigned, say I've sold a short put for 100 shares and it zipped down here and I was assigned those shares, I would probably dollar cost average in and buy 10, 15, or 20 more shares just to kind of dollar cost average into those positions. That's one of the things I like to do. So definitely some risk, but definitely huge amounts of reward on that. And anything you can trade kind of anywhere in the range between 14 and 17 strikes seem to be kind of the money makers for those, depending on how aggressive you want to be. I play it pretty safe, and I'm trading that 15 call, and I will continue to do that 15 call unless we see it break out of this range or break down to a different level. Counterintelligence says, good morning. Good to see you guys. I don't know if you're both here, Jeff, Carolyn, but let's get together when we can, when this snow just goes away. Wouldn't it be nice if we can get to spring? The magnolia buds are starting to come out, even though we got 6 inches of snow over the weekend. So I'm hoping that we get a little bit of a nice early spring here. That would be really nice. Hans Speck is asking about, I have deep in the money put option, difficult to sell. Can I buy a synthetic to sort of lock in profit? Hans, let me know what it is. You have a deep in the money put option. Okay, so, and it's difficult to sell. I mean, we can convert to synthetic positions all the time. Puts are nice in that they don't have upside risk. If we were, and I'm not sure which way you're going. Like, did you short sell this? Or do you own the deep in the money put? If you own it, then it's a bearish position. Either way, you definitely can set up a synthetic position we can walk through that if you like. Just to give me a little more information. What is the stock? What is the strike? Are you long or short? And what is the expiration? Mike Mueller says, hey there, Levi. I think your frigid cold of last week made it to me in New England. Yuck. Yeah, we kind of warmed up. I actually shoveled the driveway today with no gloves on, which is kind of crazy. So it's warmed up considerably considering how bad it was. I'm hoping that was it. We had like about 7 or 8 days of cold, and that's about it. We've got Jermaine watching from Chicago. How's your weather out there? How cold are you guys? I hear that some parts are getting like minus 40 centigrade in Canada, so that's kind of crazy. Jamie says, hey Levi, can you let me know your thoughts on Google? I think that might be one you do almost every week. Yeah, I don't. So with Google, interestingly enough, I actually don't trade that ticker very often. I typically trade GOOG when I do trade, and let me just pull up. But they're quite similar price wise, but I typically trade GOOG and not GOOGL. But they move the same. They just have a slightly different price, and I don't know why. There's no preference one way or the other. That's kind of what I do typically. Right now at 184, I'm bullish on Google from these levels. I know it didn't pull it up in TradingView, but if we look at the last 6 months, we had Google hit highs early February, and now we've had a little bit of a downturn. February 18th in the last 2 weeks, we've gone from 207 down to 184. This is a fairly significant move down over the past month. So earnings were a little bit softer than expected, and then what's going on? Are we going to continue down from here? I really don't think so. Short interest is 0.8%, and I'm a net buyer of Google at this point in time. How do you play it though? One of the things that we could do with these is play butterflies if we want to play really, really small. It is a big stock. It's cost about 18,000 for 100 lots. So if you're trying to trade cover calls and things like that on it, if we're limiting our exposure to 2% of an account, well, this in a single stock, then 100 shares of this is a large account. You need a $1 million account just to own 100 shares and limit yourself to 1% or 2% rather. One of the things that I like to do with these is do spreads. So I might sell a put spread. I might go to the options chain, and I would just look quite easily at the this doesn't show delta on here, but we can do it without the deltas. If we go to like March 21st, if we look at the puts, let's look at the puts. Kind of going old school. When I was learning how to trade options, I used to not use delta at all. I used to just use price action. So if I look out a month, which we're effectively a month out to March 21st, we're 31 days, I would look for the strike that pays approximately 1% of the strike value. So we can use that same mechanics, and we can say, here's the price, $1.93 collected to sell the 175. That'll give us about a 16 delta position. And then what I can do is I can build a spread off that. So if I wanted to collect some credit and collect some theta decay, I would sell this 175. And then depending on how much risk I want to take, I would then buy, like say a 165 and pay 60 cents. My net credit on that's going to be about $1.30. My total risk on the trade is going to be about $870. So because it's $1,000 wide minus the $1.30 that I collect. So that's kind of how I would set up the initial trade. Now, if I thought that I was bullish on Google, what I would do is I would then look at how much does it cost to buy a butterfly or a condor out of the money. So I would be looking to spend some money on these calls. And you can see the calls got really cheap today because the stock is dropping. So when the stock is dropping, it's a really good time to sell premium, sell this 175, which gained 27 cents in value today, while the 165 only lost 4 cents. So this trade is 23 cents cheaper than it would have been yesterday, or $23 more credit collected than it would have been yesterday. And these calls because the stock's moving down, have really gotten cheap. So what we can do is we can look at, say, the 195. If I thought the stock was going to go up, I can start buying positions. So I might buy the 195 and buy the 210 and then sell one each of the 113, 168. Now, if we did all that math together, let's just, and these are just single contracts, just to kind of show you guys what this would look like. So where are we here? Let's just go back to that chain. We'll just rattle through these numbers here quickly. But we're going to collect a dollar, say $1.33 for the put spread. That's going to be a credit. And then this butterfly, or this little condor, is going to cost $1.96, $1.96 debit plus 113 plus 168. So if we're doing this math, it costs about 80 cents to buy the upper portion, and we get about 40 cents to sell the upper portion of the condor. Sorry, I said that incorrectly. We would get about 80 cents cost to buy the lower portion, and it would collect about 25 cents on the top side. So we net about 50-cent debit to open this little condor. This condor has the potential of making $500 if Google was to rally up between 200 and 205. And we would be routing that on for a net credit of about 80 cents. So we get 80 cents in credit, and as long as the stock stays above 175, we make at least that 80 cents. We have the chance of making up to $580. The risk, of course, is the difference in the spread. So we would be risking $920 here for this spread, because we collect $80 to open, and if this was tested, we would be potentially closing it for up to $1,000 if Google traded under 165. When we put that all on the chart, when we look at it on the chart, what does that look like? It basically means that, let's go back here to Google. If we go to the chart and we look at the 1 month, so if the stock returned to that 200, 205 level, I'll change my color here. If it played up, I'm not circling EPS, I'm trying to show where it could go, and the 175. So basically, as long as it stayed above this area, we make $80 in this area here, and we could potentially make $500 in this little box, and then $80 again above. So nice little trade, risking some and saying, okay, well, we have the potential of making quite a bit of money, up to greater than a 50% return if the stock was to rally. That's how I like to set those up, using some sort of credit to then buy some sort of butterfly. Twilio, yeah, let's look at Twilio. It's dropping a little bit. We had those super highs. If we look at the last 6 months, Karina and I were in this. We were in this way too early. We bought back here, and it's almost a year ago now. We bought when Twilio was in the 70s, and then it dropped down, and we just rode it out for a very long time. And it finally popped up here when it hit 110. I know Karina started letting some of her shares get called away because we didn't think there was much valuation after that. And in the last 6 months, we have watched it kind of have this rise up to 146, and I was half expecting it to pull back, and could keep going, but not something I watch a ton. But I definitely think that the range is closer to that 112 level. Let's pull up Investing Pro and just look at Twilio's current market fair market value, just to take a look. Yeah, the fair value at 140. So it was trading much closer to that 16% potential upside. We've definitely seen this range from $53 to $152 over the last year. I am not surprised that it's hovering down at these levels. Should it go back up, or could it go back up? Absolutely. We never know with these types of things. Definitely with a stock like this, with the movements that it can have. What is that? What have I got there? What have I got on there? High dividend. Somehow I clicked on something. Let me get rid of that. Advertisements. That was not my advertisements. So we're not gonna advertise for people I don't know. The movements are heavy, so just pay attention. If the with a stock like this, these moves are massive, from 113 to 139, and then from 147 down to 124. So definitely play with limited loss strategies, and I would pick some sort of direction, and I would definitely lean towards slightly bullish, with not a lot of downside risk at these levels. I don't, unless we have a huge market correction, I don't think stocks like this are going to be trading back below that 110 level. So I hope that helps. Falco's asking, what is your net long in Black Swan hedge, and when do you open the last tranche? So I am currently not playing the Black Swan hedge. The reason I'm not trading it is because my brokerage, there's two major factors with Black Swan hedge. So the way that it's set up, the way that Ron Bertino originally presented the trade, which is like almost a decade ago now, the SPX was trading at a much lower valuation. We had SPX trading at like 4,000 valuation when that trade was created. The $3 short puts that are being sold to open the Black Swan hedge strategy were in a certain delta range, and they are not currently in that same delta range. So what happens is that we're trading premium that is so far, such a low delta, we have extreme risk to margin expansion. So when I was trading the Black Swan hedge last year, I had a ton of ES positions on. I was trading 111s that have risk, tail risk to the downside. I also had a ton of Black Swan hedges on. I had like 28 net long for, I don't even know, I maybe had like 5 or 6 contracts on ES that were short. I had a absolutely massive, like we're talking about, $1 million plus payoff if there was to be a market crash. Unfortunately, because of the discrepancy between the amount of margin required and where those low delta positions are, those short puts that are low delta, the gap, the valley of death, so to speak, was way too deep. So when there was a volatility crisis, which we had last August, without a move to the downside, so we can't really know what would have happened if there had been a move. My long puts, my 28 net long positions, didn't actually pay me very much. I had a couple positions that lost $10,000 each, and then my 28 positions that were supposed to be pumping out tons of money only made about 10 grand. So it was actually really pathetic. My brokerage killed some of the trades. And part of the reason that they did that was because of the difference of dates. So even though the net loss was covered, and it was well covered, we had margin expansion on shorter duration dates and longer duration puts that supposedly didn't cover it. Now, I don't really know how they're doing those calculations, and I don't want to put myself in that same risk again. So when I'm getting forced to be closed trades by a brokerage, I have to reassess what I'm doing. Even though I had tons of protection on, there was no way for the S&P 500 or the ES to jump that valley and get into the profit-making zone, if you kind of follow me there. In terms of how I would play the Black Swan hedge and what I'm doing to hedge my portfolio, because I have tons of hedges on right now, I am not worried about market crash. And market crash is great. I'll make money. I'm just not doing with the Black Swan hedge. What I'm doing is I'm defining my risk on every single trade. So that's the first thing I'm doing. Every trade that I put on when we're at market highs has a defined risk. So if I'm thinking about putting a short put on, I buy some put further down, and I know I might have $20,000 risk on a trade. I might have $2,000 worth of risk on a trade. It is defined risk on every single trade that I put on right now. I say every single one. I'm sure that I don't. I'm sure I have like a stock like Sofi that doesn't. I could lose $1,500 on Sofi, but those are not going to break the bank. I'm talking about trading with futures and things that could cost $200,000. And they can really draw down your account and force a closure. So that's step one. Define risk on every strategy. We do this when the VIX is low and when the market is high. Both those things. These are just common sense things. If you're not doing that, you're taking too much risk. Second thing, if I was to play Black Swan hedge, I would not be doing it on the $3 positions. I think that it from a delta perspective, selling the $7 puts, they cost way more margin initially and they generate more credit, and they're a way safer position because the margin expansion is going to be far less. If we sell it like a $7 short put instead of a $3 short put, we're going to collect more money. And we then, when they convert over to long puts, which is what the hedge does, it naturally converts over. We have a shallower valley of death because everything is kind of closer. So we don't need as big a sell-off for them to start making money. I still don't know whether or not the brokerage would have that same problem that we had before and close those down. And I'm not, frankly, I'm not willing to take the risk. I'm just like hedging on everything. I also just have some long puts that I'm paying for. That's a totally acceptable hedge. I don't have to sell short puts to then use that money to buy long puts. I make plenty of money from my accounts. I can take some of that money and I can buy some hedges. Hedges should not be protecting our whole account anyways. What I'm trying to do is protect some of the market drawdown. So that's kind of how I'm looking at it. Define risk. I'm buying some long puts. If we see a market crash, I should be able to survive this time because that August was awful. Mike Mueller says, what are your thoughts on Hans? Sorry, I'm sorry. That's not me moderating your thing, those messages that are retracted. So just if you could either repost your message or just change it slightly. That's Google. I don't know what exactly you're saying, but it's Google that's retracting your messages. Falco's asking, we talked about that. Mike Mueller, what are your thoughts on adding a short put to your in the money covered call strategy? No ticker, just general question. I would not do that. Okay, so in general, an in the money covered call is a short put. There's no difference. The reason I run in the money covered calls is because I want to have short puts in accounts that I can't have short puts in. So we all run into that, like Roth IRAs in the States. What do you guys have? ISA accounts in the UK. TFSA, RSP in Canada. We have these accounts where we can hold net long stock. We can sell a covered call out of the money, or we can sell a covered call in the money. By selling a covered call in the money, we are creating a synthetic short put position. Let me pull that up. I'll show you what it looks like, and you guys can see the. I just rolled one of the mine just today, so we'll take a look at that. And like these are kind of like ongoing positions, but. Just give me 1 second to pull this up on screen. So I'm going to show you an excerpt from my rolling options record keeper, which is a great little tracker. And this is very simply, do I have everything here? Yeah. This is very simply just a long stock position. So way back when ARK was trading at 43.66 last June, I was doing a buy rate. I was buying 100 shares, and what I did was I sold an out of the money call against that. I paid a net debit of 43.22 for that, and the stock went up almost immediately. So in the first month, it went from 43 to 48. We had great timing on this purchase. At that time, I collected a small credit to roll in the money. By doing that, I increased my potential and decreased my risk. You can see my premium collected to date. So the net debit on this trade was 43.22. After collecting this 23 bucks, I'm now 42.99. So I actually have more money back than I initially started, and I've agreed to sell the shares for more money. A month later, stock was back down right near my purchase price. So at that point, I just rolled out and did the 65. This is one of the reasons why I don't pay too much to roll up unless we have a market sentiment change. So stock is bumping around 43 to 48, 43 back up to 47. I've got the 47. This time I collected $1.53. Each time I'm reducing, like look at my risk. Initial risk was 43.22. Now I'm down to 4,081. Then I collect a little more and I roll up to a higher strike. 47, I go out of the money. We just continue this along. Well, let's look at what's happening right now. The market has been, ARK, we talked about it. It's in a bullish uptrend, right? So 47 bucks, 57 in November, 63 in December, $60 in January, and now 66 bucks today. Now, one of the things I'm looking at is kind of the main trend in here. So my assumption is that money is pouring into ARK. It's going to probably continue to pour in. And this stock used to be $110. So it could easily continue to rise. You'll note that I actually have been paying debits these last 4 months. So in order to move from 49 to 50, that was my first little debit. Stock was trading at 57. I wanted to be a little aggressive, but not too aggressive in case it came back down. Stock can easily move $7. The next month, it had gone up another 5. So this time I was aggressive. I want to stay in a range. So when I'm talking about in the money covered calls, you know, the 5,600 is the max that I can get out of this. If this was to trigger and these calls were taken away from me, this is still a gain. I'm only 4,600 into it. At the next month, stock was down a little bit and I rolled up a bit, you know, but still keeping in the money. These are how I like to manage this type of trade. Now, February, we're at that 66. When I'm looking back at December, 63, down at 60, 66, I really want to stay in a range where I'm making some money, and I need to increase the probability of making some money in case we just start to rally really, really hard. So even though I keep putting money in, today I put 288 bucks into this trade, I'm still net only 4,900 into a very winning trade. At this point in time, the stock is trading $4 above my 62 strike. And if I get this called away, I'm getting called away and getting paid $6,200. Let's just scroll down and see what that looks like. Here's the chart. You can see I've been taking a little bit more risk as the stock has been rising, but this is a winning trade. I don't mind putting money into a winning trade. Stock is definitely on an uptrend. I have my profits capped, but these are very reasonable profits. If I was to get this called away for 60, what's my current strike? 62, right? 62. If I was to get this called away for $62, I would get a credit to close of 6,200. In a 237-day period, this is a 26% return if it was to get called away today. We're talking about 40% annualized return on value. So when we're looking at this, we have to think of the whole portion of the trade. What are we making relative to how much we're investing? Do I have some safety on this? Absolutely. Am I making theta decay? Yes. So if we were all of a sudden to see a retraction, I mean, in order for me to break even at this point, we'd have to be trading under $50, which is quite low. That's what I'm looking at when I'm making these adjustments. So I want my profit profile to rise where the stock is trading. Move this over just a little bit so you can see what each of those lines. But the yellow line right here, the second yellow, is what I'm in right now, the March 21st 62 call. And that's this line, and I can hover over it. And what I'm doing is I'm increasing the profit profile where the stock is trading currently. And I'm paying attention to this break even. You know, I don't want to put myself in a losing trade. But at this point in time, I think we're going to continue to go up, and I want to stay close enough that I can make some money. So that's why I paid to roll up multiple times in the last couple of months, because we're seeing the sustained move. And we can, if we go over to our K on TradingView, and let's just take a look at it again, because we talked about it before, but definitely in this channel. So that 49 level, just to put it in perspective of where we are, 49, which is my current break even, is here. So the stock has not traded in that level since November. And that's when my current break even is. That's why I'm putting more money into the trade. I want to just chase this range a little bit. It could easily drop down to 55, in which case then my covered call comes out of the money and it expires and I sell another one. Does that all make sense? Type 1 in the chat if that makes sense. With regards to your question, Mike, specifically about the short puts, it's one and the same. If I had a short put at 62 or I have a covered call at 62, I have the risk is the same to the downside. So I don't typically couple those two strategies together. I mean, technically the wheel is like short put and covered call, but I almost always on my stocks that I'm wheeling, I start as an in the money covered call, and then that it either goes in or out of being a covered call, and that's it. But I just own the shares. Counterintelligence, glad the cold snap is over. I can't say I'm excited about the snow. I kind of thought we were going to skip winter this year. Me too. Caitlin says hi. Looking forward to seeing you, coming to see your place soon. Yeah, it would be awesome to have you guys come out for the weekend. Love to host you. Brendan says happy Wednesday. And is it Wednesday already? No, it's Tuesday. But thanks, Brendan. Good to see you guys. Can we look at Shell? They're currently doing a share buyback. The Hans is asking. Okay, let's take a look at Shell. This is a stock I never trade, but 1 year 6.85. What are the options like? You know, these, whenever I talk about like oil sector, like XOM, BP, things like that, I would think about, you know, these are obviously dividend pairs. Like if we look at this, why that's telling me that I have to upgrade to silly. The yield is 4.1%. 4.1% is the dividend yield right now. So if we hold stock and the stock over the course of the year goes up 6% and we get a 4% dividend, we've had a 10% return on capital. With stocks like this, there's always potential for the stock to go up because the price of oil could go up and then all of a sudden their profits go up. So when I look at these and I look at the monthly, I often am saying, okay, well, how much money can I get? Can I get a little bit of money selling that 70 call? Well, I am getting an extra 70 cents. If we did this for the whole year, let's just pull up the calculator and say we got 70 cents for the year. So 0.7 times 12. And that's $8.40. If we divide that by the current price, which is 68 bucks, that's 12% return, selling that 70 call. I think that there is tons of money in these oil stocks. And I've answered questions on these before where I've talked to people where they're like, huge holding, you know, you've got, $300,000 worth of XOM shares and the dividend's huge and the stock market, the move has been great. And you're like making all this money, you're making 10% a year. By not selling the calls, a person is giving up 12%. When an account is big enough, when those call, at least a portion of them, you know, look at it like a dividend. If they go in the money, fine. If they get called away, fine. You know, oftentimes you're doing very well. Making a 12% dividend for selling an out of the money call every single month on those positions that don't move all that much, it seems like a no-brainer to me. You know, obviously, I'm gonna push this button. What does this button say, everybody? Disclaimer, not financial advice, but that's what I would do. I actually don't hold a lot of oil stocks. I don't think I have any on the books. I occasionally do play ratios and things like that on XOM. That is one of the ones that I like, but I can look at Shell and say, oh, the premium is the same there. It doesn't matter what we're doing. BP, XOM, Shell, pick one, pick your favorite. Where do you like to fill up? You know, that's how you do that. What else are we looking at? We're gonna look at Falco says, thank you. You're very welcome. Mike says, regarding the short put with a covered call, I was thinking of a covered strangle, but that may only make sense when you're out of the money. Yeah, they're the same. Like if we looked at a short put, and a covered call, let's pull one up. Let's take a look. Because both things you're taking tons of risk on both positions, and the risk is similar. So how am I going to do this? We're going to go, I'm just going to pull this up for a second. I'm going to go to the comparison tab. I have this really cool, you know, my rolling options record keeper is I like to brag about it because it's awesome. I don't show off the features enough, but let's look at Shell. Let's pull up Shell here. And what is the current share price? We're at 68 bucks. And let's do a buy right for March 21st. And oh, that is no good. I messed this up. I'm going to show you guys something that upgraded my strategy test last week, and that's not linked. I gotta just fix something in here. Sorry. All the behind the scenes programming, you guys can see like how this sheet functions. I forgot to update this on my own. This was a bit of a mess that I did to myself. Let's just repopulate that. It's not going to, is it? It's never going to do it when I want it to. Yeah, it should be doing that. That's what it's supposed to be loading. Okay. One more there. All right, and then that's working. So hide that. Don't mess with my sheets too much. But that's the behind the scenes of how the sheets work. All the programming behind. Try to make these function here. So okay, what I was trying to get was my color coding back. It still looks like it's not functioning. Something else is going on here. So it's got a call. What it's looking for is calling this number. And it's pretty cool programming, actually. It took me a long time. This has been like 6 years making this sheet. So this didn't just come out of nowhere. What are we doing here? We're going to hide this. Hide a few rows. All right. And then we're going to freeze up to that row. Okay, let me know this. You can just watch me fumble around. Okay. If we were to do this, we're going to sell the 70, right? So we're going to sell the 70 and we're going to collect, if we do it as a buy right, we're going to collect 70 cents for selling this, the 70 call, and we're going to pay $68. So I can simply enter this in as a minus 68, a plus 0.71, which was what we were getting. And so 67.29, and I'm just going to delete these for now. We're going to get rid of those. And if we let's get rid of that, so we won't have anything crazy. That's what the profit profile looks like if I do a buy right, buy the shares for $68 and sell a covered call. I have all this risk to the downside. Now, if I did this as a short put instead, let's pull this up as a short put. So we go, we're going to do a put here. We'll do a cash secured put, 321. I'm not going to buy the shares. And in this case, what are we going to collect? We're going to go over and take a look at this options chain. And that 70 put is going to be pay us $265 for selling the short put. So I would sell the 70 and I would collect $265. And you're going to see this is like, it's so identical. It's so close. Now, let's just say that we have one of these positions on and we're adding something to it. So I'm just going to go to custom just to make sure that we can do this. But let's say that I buy 100 shares and I sell a short put at 70 and I sell a covered call at 70. And what it happens here? This is also going to be March 21st. And the total debit on that is going to be equal. So it's going to be minus 68 to buy the 100 shares. And then it's going to be plus 265 for selling the short put. And then plus 71 for selling the out of the money cover call. And we're going to be net debit at 64.64. But look at the risk I'm taking. When we compare this risk is double. You know, this is that yellow line when we look at this comparison. I've got a blue red line that are the same and yellow. So I've effectively taken twice as much risk by adding this. Typically what I want to do is do something different to that, which is reduce my risk. So I might do a 70 put and then do a 70 call. And now what we'll do is we will put in the net credit for that. And let me just load this up as a custom here. This will be a straddle, right? So, oops. So we'll put this in as a short straddle and we'll do March 21st. See how easy this is. We can say equals, and now what would we get for this? We would get $2.65 for selling the the put, and then we would also get 71 cents for selling the naked call. And no shares at all in this. And I'm putting in one of those. And then that should chart that. Now I have a more reasonable risk profile. If I was going to add risk, where would I want to add risk? I would want to add the risk to this side, not to this side. I want to reduce my risk on this side. So this is the type of thing that I might do. I hope that makes sense. So that's how I think about these things. And when I'm looking at a strategy that already has risk to one side, I typically am not adding more risk to that same side. I'm adding risk to the other side to increase my profit profile. Now, if I zoomed in here, let's just zoom in a little bit and look at this chart. So because I don't really expect Shell to trade in this crazy way. Like let's go back to that chart and look at Shell and say, well, where did it trade for the last month? Maybe we'll look at TradingView, but in the last month, it traded as high as 68 and it traded as low as 64.42. So let's take a look at that range based on this chart now. So if I was to look at that 68 level, 68, which is where it is right now. So this is that zone, and then 64.40. So this is the zone that it traded in the last month, right there. That's the last month. Which of these trades do we want to be in? Now, I certainly don't want to be in this yellow trade. That has more risk than anything. Oops. Let me get to the right thing here. We've got this this yellow line here that has more risk. If we traded back down at 64.42, I would be down about $600 if I took this trade that has 200 long deltas to it. Sure, I have potential to the upside, but that's not where the stock has been trading. The stock has been trading here. So I have to look and assess. That's why this green trade actually makes a ton of sense. Even if it was to go to $70, it has way less risk. It has the least amount of risk, even though it has the short call. But that's that's one of the things I'm thinking about. TN, isn't it better to just trade a vertical spread and manage it early if it goes down? With regards to the short put, or what are we talking about, TN? Like I am totally on board with what you're saying. Earlier in this stream, I talked about what I'm doing in my own account, and I'm defining risk on every trade. So when I have a defined risk, and that example I showed on Google, which is a spread, if it goes down, then the conformity of the move is not exactly matched to the shape of the profile. So if we were to take a look at, say this position, if I wanted to buy a long put, let's just change this out here. What are we going to do? I'll just match these two columns. So comparison 3 and 4 are very, very similar now. They're going to chart the same. This is going to be 336. And then I might spend some money and buy a long put. So let's zip over and look at what the option pricing is for that. We're looking at the calls. Let's look at the straddle here. And maybe I'm selling that 70 put, and then I am defining my risk and saying, well, I'm going to buy a 65 put. What does that do to this profit profile? It actually does quite a bit. If I buy a long put for 6 cents, is it really that cheap to buy the 65? There's like no downside risk in Shell right now. It's just like everybody's bullish. 65 put. What's the date here? The date's wrong. That's why. So 265. The 65 put is worth 44 cents. That makes way more sense. Okay, let me not give you incorrect information here. So we would be equals 336, which is how much we would get for selling the straddle. And then we would subtract, it would be a debit of, what did I say, 44 cents? We're just going to call it 44 cents. So 292. And what that does is it gives us a defined risk trade, this yellow line now. And if we were to draw that zone on here again, that 64.50 to 68 range, we're not making as much as the green line, but we also have way less risk. If this stock sold off and was the incorrect direction, I mean, obviously these are all bullish positions. They all want the stock to go up to $70. We can see by the profit profile here, that's where all of the money is being made. But if the stock stayed if it dropped, this long put would gain some money, and it would be super smart for us to readjust. And that's why I have my rolling options record keeper. So if we were to like look at a position, let me just pull a different one up as an example so that you can see kind of how it works. Let me just see, what do I have here? I just have to find the right type of setup. Bear with me for a second. Palantir, no. What am I looking for? Do I have a really good one? No, I haven't been making a ton of adjustments because the market's been going exactly the direction that I've wanted it to go for the last little while. So there's been not a lot of adjustments. I've been just trading quite well off the open and letting them just run. But last year we had quite a bit of adjustments going on, but I always have, typically a profit 10 to the downside. So when we're getting this kind of choppy market action where we stay in that range, it's actually been really good trading so far this year. And it's why we're doing so well overall. I was trying to find one that was a good adjustment, but there's nothing. Everything's a little bit on the complex side. Here's one I guess we can look at. Here's this AMD trade. I mean, this is kind of how we would look at how we can adjust these over time. I actually just adjusted this today. So my current profit profile looks like this. If AMD trades up above 130 over the next 3 days, which I totally don't expect it to, then I could make up to $1,772. But I've taken off all risk, and my current position is a net profit of $972 at the very worst. That's the minimum I can make for this trade. I've been in this trade for quite a while. It was an experiment with playing a longer dated kind of cheap big butterfly to the downside, this big condor down here when the stock was trading up here. So this pink U shape, it shows me where the stock price was. This is that vertical line and where it currently is. And what I was looking for was trading short duration put spreads against a longer dated condor. And this paid off extremely well. I mean, this is making what was my max risk on this trade. If we were to look at one point in time, I had a max loss of $900. I think that was the most I ever had. So I had $900 worth of risk on it at one point in time. And this trade at minimum now is going to pay me $972. So it's over 100% return at the very least. So even if I get nothing more out of this trade over the next 3 days, I've had a 206% return. It has made me at $5.49 every single day since I opened it for 174 days straight. This is why I built the Rourke, to be able to customize this and look at what the output is and say, when I make an adjustment, what is that doing to my profit profile? How does it work? It doesn't work super well with diagonals, works extremely well with trades like butterflies. So when we have that similar expiration date, building this out, it works really well. And I've recently expanded it out so you could do whatever combination of things you want. There's like how many here? 4, 6, there's like 12. You could do like a 12-legged trade and you can overlap these and you can chart them together. So I spent a lot of work on this spreadsheet to get it to function, but what it's allowed me to do is on the fly build these tents out and see what kind of profit I can make. And it's made me a much stronger trader because I can understand visually how the adjustments work. So if you're not part of my Patreon community, that's one of the perks of joining my Patreon community in the options tier membership. You head over to Patreon, check out the Options Trader Club. If you you can sign up for free if you want, and then you can just get on the mailing list. I'm sure most of you guys are already on the mailing list already, but if you're looking for a copy of my rolling options record keeper and you want to see this live copy, which I has all my trades on it all the time, those are the membership perks. So if you head over to Patreon, you can check that out anytime, and you can get in the Discord chat, which is awesome because then we get to talk like this all the time. And yeah, so I just, TN, I see that you put a bull put credit spread. I just don't know in regards to what you were saying, isn't it better? Like, is it better than a short put? It can be. There's a cost to that long put. So whenever we're talking about whether or not something is better than something else, I mean, technically, if we sell a short put comparatively to a bull put credit spread, there is less profit potential on dollar-wise on the bull put spread than there is on the short put, because there's a cost to buying that long put and defining that risk. Now, from a return on capital standpoint, the bull put credit spread will always win over a short put, because short put has tons of risk. So you've got like a massive amount of valuation that you've had to, or a lot of capital that you have to put at risk in order to make a little bit of money. And when you look at a short put chart, they actually kind of don't make a lot of sense. You're trying to make $100 and you're risking like 10 grand. It's like, it doesn't, that doesn't make a lot of sense. Over the course of a lifetime, they work pretty well as long as you're a good stock picker. As long as the market goes up, then you make 1% a month and $1,200 return. Like if you made $100 a month on a $10,000 position, at the end of the year you've made $1,200. Well, that's 12% return, and it's pretty low drawdown for the most part, as long as the stock doesn't have a huge crash. When they do have a crash, you're buying at a really good level. So even if you get assigned, it's a very smart strategy. I'm not knocking the short put. Is a bull put credit spread better? In my opinion, I think they're far superior, because now I can take more contracts, so I can have similar risk. When they go against us, they suck. Bull put credit spreads suck. Okay, I'm feeling like, I was gonna say, I feel like I'm done for the day, and it's 11:59. How about that? We're right there. I'm gonna say thank you guys so much. Let's get rich together, which is what we're trying to do. If you have any questions, you need to email me. Just drop me an email, leave a comment below. Thank you for everything. I will see my patrons. Oh, actually, you know what? No stream this Thursday. I'm heading to Arizona on Thursday morning, so I will be super light trading for the rest of the week. I'll do some trades tomorrow morning, and then back in the chat room next week. But no live stream on Thursday for my patrons, but I will be on Discord. So you guys are amazing. Thanks so much. We'll see everybody next week. Take care. Bye.